Hey, welcome back to Two Super Guys Trade Stocks. I am Dylan.
And I'm Vinny. Today we're talking about Dr. Michael Burry making a time-based prediction around a similar event of bank failures and how long it took to reach a market bottom. We're also going to talk about CPI and PPI numbers that came out in the last couple of days. Really moved the market a lot, okay?
Two Stupid Guys Trade Stocks.
So, what spurred this exact video here is this tweet from Michael Burry. He's basically talking about the Panic of 1907, for those of you who are not familiar with it. The Knickerbocker Trust. Have you ever heard that name before in your life?
That's a bank?
I love it.
Or a,
It
okay.
was.
All right.
So back at this kind of time period, banks and trusts were separate under different capital requirements. The banks had to have like 25% reserves, as trusts only had to have 5%. 5%, and the trusts were allowed to loan for overnight stock purchases. They were basically doing the immediate like cash unsecured loan and then getting it backed up by like a bank at kind of after 24 hours. So you end up having this like run on trusts.
Yeah,
What ends
that
up
makes sense.
Yeah. Not surprising,
I'm
right?
pretty
It's
sure
kind
that
of
they got to all be dead. That's a horrible rule.
Well, it's kind of eerie how similar it is because, right, where did the issues start this time? It started with regional banks, which are not held to the same capital requirements as the big national banks. Hello, history repeating itself, right? But the interesting thing here is in this time period, this is pre-Federal Reserve days, all right? So there was a private kind of conglomeration that stepped in to back up the banks. You got J.P. Morgan and John Rockefeller and other very wealthy individuals literally taking their own cash and putting it into these institutions to prop them up. Wild, huh?
I'm sure they got something in return there.
Oh yeah,
I
they were
don't
doing
think
this
it
entirely
was.
out of the goodness of their own heart.
Yeah.
They were going to benefit them, right? But he talks about how like it was J.P. Morgan that made a stand, and then 3 weeks later the stock market bottomed, right? And a stand was made this past weekend, meaning that we're within that time period. The night when you go back to 1907, it was October 16th is when the stuff really kicks off, and by November 6th, it's over with.
Okay, that's
Fast,
pretty
huh?
fast. I mean, there's definitely a lot more variables this time with interest rates. That's going to be kind of low.
Yeah, exactly. And then, the market was already in a pretty kind of hefty down trend already at that point. You're talking about just this last little portion here that was really caused by this. Not terribly
Okay.
dissimilar. We've already been in the downturn for a little while in the current market. So maybe we do find like a new bottom. We've come up off of it a little bit. Finally had today flash into the negative for the year, actually. I think that was the first time. Ultimately closed back in the positive, though. So he had a couple other kind of tweets here that were interesting. Talking about like the hubris and greed of bankers and how the money printer gets turned on and bails them out. You ever heard this saying where it goes, if you owe $100,000, you have a problem. If you owe $100 million, your bank has a problem. If you're a bank and you owe $100 billion, the taxpayer has a problem, right?
Yeah, except apparently the taxpayer is not footing the bill on this one.
It's a question of semantics, all right? Not the taxpayer, but you know how they would ultimately close any gaps here in this? Have you heard anything about this?
Mm.
So
I
the
was slammed
federal,
today.
yeah, it's all good. The FDIC can levy a special fee upon its insured members to recoup any losses.
Oh,
So
right.
all
Okay.
banks in the country that are FDIC insured would have to pony up this money. And where do the banks get their money from? Hello, Mr. Taxpayer and bank
Yeah.
customer.
Yeah. Okay.
Same
So
group of people.
it's still
Yeah.
from us.
Yeah, exactly.
There was a good just in terms of what he just said about people taking risks. I'm going to butcher this, but there's a saying in the stock market and especially day trading is that success and stability go hand in hand, but stability will breed higher risk. So what'll happen is you'll be doing well, you're doing great, and everything's going well for you. It's like, oh, it'll take a little bit more, right? I've definitely done that 100 times. And then it works until it doesn't, and you're fucked.
Yeah,
Probably shouldn't
exactly.
have said fucked.
It's all good. One last tweet that I thought was kind of interesting here. This is not something I kind of dove into deeply, but I thought kind of wild. Talking about the overconcentration of this ESG investing that was heavily kind of invested in SVB Bank because of their exposure to green energy. So it's kind of ironic that your exposure to trying to save the world means that you lost money on this deal.
Yeah. And I bet DuPont is doing very well. So
Yeah. Philip Morris probably fine. Okay.
great.
All right. So CPI numbers came out yesterday, basically, and it was up 0.4% for the month, 6% annual rate. Definitely coming back down, but still, kind of higher than the 2% target goal. Yes, the Federal Reserve is having their effect. Yes, they probably have to stick with it for a little while longer. The market is still pricing in a 25 basis point hike for the next meeting. But overall, this is reasonable. This is kind of in line with where it makes sense that it's going, right?
Yeah, I thought on larger time frames, like not the month, but the 6 month, a year, it's still been increasing and hasn't dipped, right? I can't
It's not
remember.
that it hasn't dipped. It's been really stubborn. If you're looking at core CPI on like that 369 kind
Yeah.
of 12-month lagging, you're still talking about 5%, which we're getting very close to in terms of a Fed funds rate. Because conventional wisdom used to be that you have to take the Fed funds rate up above the actual inflation rate in order to be able to break inflation, and we're pretty close. We're like almost at that level at this point.
Oh boy.
So yeah, it's okay. But this right here is if you're looking back over the last year, we did put it on our peak quite a while ago. Definitely still downward trend, positive direction. You see this gap has kind of gotten a lot narrower here between the actual core CPI and the overall headline CPI number, which is kind of interesting, just from a standpoint of gas and kind of food and gas are part of the excluding it from the core. And in the beginning, they were starting to give us like a little bit of a kind of headway here because they were coming down significantly, and now they've actually started to trend back up a little bit. The kind of core CPI on a
Yeah.
month over month basis.
There was a
Sure.
time where I thought gas was going to be like 160 for a while, or oil, not gas.
Yeah. No. Oil was down 7% today. Actually, it was one of
Yeah,
like the worst days for oil in history, I
they
guess.
got
Um,
tanked.
Yeah. So this is what moved basically the whole market today was PPI numbers came out. So PPI, one step up that kind of supply ladder. You're looking at producer price index came down 0.1% over month. So like this is actually a contraction. Yeah, I'm positive. Going the right way. The big things you saw here is that 0.1%. When you exclude food and energy, they still went up a little bit. They did have a little bit of a tailwind there because of that kind of price in food and energy there. Still 4.6% annually, so that's like still a decent sized number. We're now moving it to Fed funds rate that's going to be even higher than that. So on this kind of we've surpassed that level, if you will, because we'll be moving the Fed funds at 475 to 500 probably after the next meeting.
Yeah. And so that's kind of interesting, right? Because I think before the banks took a, nosedive, they were pricing in a decent chance of a point 0.5 hike, correct?
Mm-hmm. They were indeed.
So now it becomes an interesting situation, right? Do you do what's best for the economy? Because you can really argue that this is not a bank systemic risk. This is
Okay.
really SVB over lending to a bunch of tech companies not having a backup. It's more nuanced than that, I understand.
Yeah.
And then Signature, but they also have a whole crypto hold where banks were going to them for crypto. It's not all
Yeah.
banks. It's very specific situations. It's not like in the news where all banks are dying. JP
Yeah.
Morgan, Schwab, they're all fine. Like,
Well, the big question there is they all have a lot of kind of unrealized losses on their balance sheet, right? Because banks bought a lot of treasury bonds, some of them very long term treasury bonds, when interest rates are really low. And we've talked about the inverse relationship between kind of prices for bonds and like the yield.
mhm.
So they're now underwater on all the bonds they were buying 2 years ago because of the Fed funds rate being so much higher, right? Or interest rates in general being so much higher. So they're carrying a lot of paper losses. So they really have to be able to carry these bonds to maturity in order to, kind of fully realize the value that they have. And when you have a short-term kind of liquidity issue like SVB experienced, you can't really do that. So what the Fed is doing now with this kind of par value borrowing facility is they're allowing all these banks to borrow at the face value of the bond, basically.
Right.
So they don't have to take that discount anymore. They can get the full amount of cash, and they're not like in a panic trying to sell off bonds like massively. Because if you've seen bonds have gotten hit really, really
Oh,
heavily
yeah.
over the last like week.
But I guess why couldn't you do that and do a point 0.5 hike?
I mean, they could. They definitely could.
Yeah, they're not going
I
to,
just
but I feel like I would.
yeah. Oh, interesting. I mean, it's a question of prudence, I guess.
Yeah.
How aggressive do you want to be? Yeah.
That's
Now,
one
if you want to look
stupid
at the
guy's
charts,
opinion, just to be clear.
yeah,
I don't know.
I know, right? If you want to peek at the chart from today, it's pretty wild.
Oh, you got it up? Up a dip up a slight delay. Oh my goodness.
Yeah.
There we go. It's trying to no radio silence. All right. So here's the SPY. Let me move my face. I'm gonna be honest with you guys. Technical analysis is kind of useless when you have this much volume and this many fundamental things happening. So
Yeah.
really, all you can get from this is that the SPY is still extended from the 9 EMA, still under the 200, which is this line here. It looks like it's still in a downtrend. They gapped down. They did get a little bit of ground back, but you know, there's just not a lot to look at when you have this much volume. The Qs look pretty strong.
Yeah. Interesting.
So Qs threw up some pretty mad volume. You know, went up, gap down, went up higher. I don't see tech falling a lot. I do see other things falling. It's really heads or tails on where we go from here. It's kind of, I'm not going to lie to you guys. It's like technical analysis is useless when there's stuff like this happening. So
Yeah, I mean, it's been interesting. I was up today on both of my accounts. Usually they're kind of opposite each other, but like my main account was up because Apple had a good day, Google had a good day, Meta had a good day, and then my kind of more bearish position on Tesla actually that spread actually was positive today. So it's
nice.
like I don't really know. It's we're in a weird market right now. Where if you're watching an intraday at all, it's been like swinging wildly.
It's insane. Yeah, I closed my Carnival puts. I re-entered, so I got a bunch of profit. I got 20%.
Nice.
But I mean, it could fall a lot more. I have no idea. So complete guess.
All right, guys. Well, let us know what sort of moves you're making out there. I'd love to kind of hear your thoughts.
Yeah. Give us a like and subscribe. And we got some good videos coming this weekend. Thanks, guys.
See you next time.